Another strong quarter in the books for Affirm as credit quality, well, that stays stable. Let's get right to Affirm founder and CEO Max Levchin. Max, good to see you here in New York City for a change.
For a change.
Yeah, before we get to the quarter, I follow you avidly on Twitter, and a couple weeks ago you put out this higher for longer rates. You seemed excited about it. Why is that, one, why are you excited about it, and does it benefit a company like Affirm?
It's not a benefit, but I think there is an oft-repeated narrative that it's a huge problem for Affirm that the rates are not coming down, and that's just plain inaccurate. Generally speaking, the reason I said higher for longer is a good thing is because that's an outcome of the Fed basically saying, hey, prices are not coming down, inflation is a little sticky, we're going to keep these rates a little higher for a little longer to make sure that the economy cools down just enough. What that means, though, is the joblessness situation, the job claim just came out today, moved up a little bit, but not a ton, still under 4%, reasonably healthy. So long as we are keeping job losses in check, people are able to spend, people are able to transact, people are able to pay their bills, and that's really good for a firm. So higher for longer is an outcome of a not great situation with inflation, but not a terrible thing for us. And as we have proven now over the last couple of years, so long as the rates remain reasonably consistent, we're able to print an excellent quarter, just like we showed yesterday.
What are you seeing in terms of charge-offs?
Still quite stable. You saw that they ticked up a little bit, but all within the ranges of very, very reasonable delinquencies. 30 plus is what we report to the street as kind of the forward-looking metric. Down a tiny bit, but again, very reasonable. We expect some seasonality coming through the summer, typically a slight increase in rates, but generally speaking, our consumer is still borrowing, spending, paying us back. Never a so go to sleep and don't look at it again sort of situation at Affirm. We look at it all the time. At any given day, there'll always something to look at and obsess over, but so far so good.
I know you're not an economist, but you have a great insight into the health of the economy. And look, we see consumer sentiment readings. They're not great. People are pissed off about inflation. What's your read on the economy?
Again, I think there's a lot of people who have read the news and said, well, the economy's not doing so hot. In reality, price of eggs is up a lot. Some other prices are not up. In fact, they're down. It's averaging to a number that's not the 2% target that the Fed had set for itself, but it's not exactly at 9 points where we were looking, a year or whatever ago. And so I think generally speaking, the economy is actually in a better shape than the popular opinion will have you believe. I think some of the complaints you're hearing is actually from the upper echelons of income. If you look at the wage growth, I think the lower income groups have kept up better than the higher income groups. And so I think it's a little bit distributed. But from where we sit, people are spending, people are still traveling, which is an important growth vector over the last 12 months. People are still buying nice things for themselves, which is good. We're helping them finance it. And again, they're able to pay their bills back on time to us.
Doesn't sound like an economy that needs a rate cut.
That's where I stop at The Economist. Like, not for me to opine where and when to have rate cuts. What I do know is that we don't require a rate cut to be successful. Again, another great quarter just yesterday, and looking forward to the rest of the fiscal year for us in fiscal 25. Higher for longer is okay.
I want to read this headline for you because I think you'll appreciate it or have something to say on it. Phantom debt from buy now, pay later schemes is a $700 billion black hole that economists aren't accounting for.
That is what they technically call clickbait. That math is so wrong, it's worth doing it on air.
What is phantom debt?
Well, the claim is, not mine, and erroneous as it may be, is that buy now, pay later is this thing that is existing in the shadows of the economy. It's not reported to the credit bureaus, and by year 21,000, it will reach some obscene number. And all of it is wrong. First of all, monthly installments, which is part of the overall buy now, pay later system, has been reported to the credit bureaus, and it's been reported for a very long time. So that's just not a thing at all. So whatever indebtedness you see in the consumer land, it is visible in the credit bureau data. Part one. Part two, there's a fraction of buy now, pay later industry called pay in 4. Sometimes people call it split pay, sometimes they just call it BNPL, but that's the pay over 6 weeks. And weighted average life of that loan is 3 weeks. That means money turns 17 times a year. Last year's overall industry estimate for the US was $50 billion. That's $3 billion in outstanding balances. Total US credit card debt $1,100 billion or 1.1 trillion. That's 30 basis points. 30 basis points of debt that is not revolving, not generally speaking, compounding, doesn't even pay interest 90+% of the time, is not reported to the bureaus. That's phantom debt. You're terrified of 30 basis points of US consumer debt. That is just a headline that's made up to get people riled up and click on headlines.
Do you think that people are paying your bill first as compared to a credit card company?
There's a great question. I think they are paying our bills in a very predictable fashion, because whenever they agree to use Affirm, they see not just, well, here's your bill, please make a minimum payment, don't worry about the long term. So the buy now, pay never, which is what credit cards are, or buy now, pay forever is probably a better term, is a stark difference to what we do. We present the entire plan, you know exactly when your next payment is due. Generally speaking, it's quite rigid, which may seem like a problem, but in fact, it's a huge benefit. Consumers love the sense of control where this is the bill, I gotta pay it. Of course, if you need to have a little bit more time to pay later, slightly later, we will accommodate you, and there are no incremental fees or compounding interest. That is what gets us into this gray zone where people, generally speaking, pay our bills just fine. Some people prefer to have their Affirm in the best standing possible, and so I think they do prefer us to their credit card bills. Some, I think, just paying their bills on time. As you saw, 2.3% delinquencies, 30+ last quarter, suggested they are paying our bills.
Good thing.
Good thing.
You and I have talked, in the couple minutes we have left, you and I have talked in the past about AI, and I can never tell if you're like, man, I can't believe this guy's asking me this about this again. Everybody in my life asked me about this, but let me ask you from this perspective. Since we have last talk, we are Warren Buffett out here at his annual shareholder meeting talking about the genie is now in the bottle. Apparently some weird video of him was posted and it wasn't actually him. Is he right to be that concerned about AI? And I should note too, yes, you're the founder and CEO of Affirm, but you've spent many years in tech industry, and of course we're there for those early days of PayPal.
Mm-hmm. So I think, generally speaking, I am an extreme techno-optimist. And so asking me, should we be worried about some amazing technological breakthrough, that's another form of clickbait. Like, no, we should not be. We should be excited about all the opportunities. We're going to make amazing things, efficiencies, assistants, co-pilots, all of that is coming. Most of it is not ready for prime time. That an important thing to be worried about is how far have these valuations run ahead of themselves. There's some amazing things happening, most of them in labs. That said, we announced in our last quarter, as it happens, that we have, for a long time now, been experimenting with AI as a customer service agent. We still guarantee that any human who wants to talk to a human will be able to do so. But we found that our ability to satisfy consumer requests, questions, complaints, whatever it is they have, with a chatbot that is powered entirely by our built AI is really, really strong. 60% of the time, a little bit higher now, the consumer says, oh, okay, great, that works for me. I don't need to talk to a human. Lots and lots of Gen Zers and millennials like chatting, don't like talking to humans. They get their satisfaction through a chatbot that is AI powered. Very cool. They need to say, hey, I gotta talk to a person, you don't get me.
I still need to talk to a person. I guess I'm the old guy now.
You're the one mashing the button like, operator, operator.
Yeah, okay.
We will always have that. We'll always support that modality of interaction. But a lot of people get their questions, simple ones anyway, done very quickly with a single interaction with an AI.
All right, well, I promise not to ask you about that until, I don't know, a couple months from now when we talk again. Max Levchin, founder and CEO of Affirm, always good to see you. Appreciate it.
Good to be here.